Hi. Fixed income markets had turned somewhat volatile over the last few months, with bond yields rising despite the RBI having cut repo rate by 100 basis points and proactively infused liquidity of more than 8 lakh crores. Let's start off by examining what are some of the factors affecting the fixed income market in the near term and what the outlook is going forward. So, you will recall that most of the fixed income market volatility started from the June RBI policy, where, unlike market expectation, the RBI changed stance of monetary policy from accommodative to neutral, thereby giving a signal to the bond market that possibly the reliance on monetary policy going forward has to be lower. In fact, the bond market took one step forward and started to think that probably the rate cut cycle itself is over. That evidenced itself in an across the board rise in yields, and market participants basically started to position for a long period of no more rate cuts. So that was basically the first trigger that affected the bond market. More recently, and especially after the GST rate rationalization, there were some participants who began to fear some sort of a fiscal slippage as well. Fiscal slippage means additional bond supply, and that also has some pressure on bond yields. And a third factor, which is lately been more affecting the bond market, is basically demand and supply for duration. So as you would recall, over the last few years, the government of India has increased the average maturity of issuances, which means that earlier they used to borrow something like 12-13 years of average maturity. But lately they have been borrowing more than 20 years odd of average maturity, largely to cater to the pension and insurance sector demand. However, lately we have seen some of that demand come off, whereas the issuance profile of central government securities has remained pretty much biased towards the long end. Also, we have seen since April the issuance profile of state development loans or SDLs preferring long tenure issuances. So, the average maturity of SDL issuances has also picked up. Combined, that has created some bit of a duration fatigue in the bond market as well. So, to summarize, over the last few months, a change in RBI commentary, some bit of fears with respect to possible fiscal expansion, and some bit of fatigue with respect to duration absorption in the market have all been playing on the bond market. However, we think some of these factors have largely either played out or in the last leg of playing out. As far as RBI commentary is concerned, we think the market is now reconciled that the RBI may not have meant the commentary to be as harsh as the market interpreted it to be. In fact, with rise in global growth uncertainties and a further fall in inflation owing also to the GST rate rationalization, we think there is a good likelihood that RBI cuts rates at least one more time, probably in the December policy. And we expect in the run up to that, the commentary itself to start to change somewhat towards more dovishness. So we think largely the impact of hawkish RBI commentary is behind us. As far as the fiscal pressures are concerned, the finance ministry has clarified that in all probability the fiscal deficit targets will be met, and therefore bond markets concern with respect to additional fiscal supply is also pretty much behind us. That leaves the problem of demand versus supply, especially for duration bonds. What we are given to understand is market feedback has gone to RBI, and one hopes that there is some tweak to auction calendar, etc., that may be done in order for a better accommodation of demand versus supply. Against this all, the macroeconomic backdrop remains quite constructive for bonds. So the US, which is the largest economy in the world, is finally slowing. That is leading to expectations of Fed rate cuts coming back. So the market currently expects the Fed to cut more than 100 basis points over the next 12 to 16 months, with the first cut coming imminently. Global growth per se has slowed, which means that pressure on commodity prices has fallen off, which means that local inflation pressures are also lower. And because of a variety of reasons, and despite the positive growth impact of GST rate cuts, there is still a good likelihood that RBI will have to continue to play a supportive function as far as growth is concerned. So against this relatively bullish macroeconomic backdrop, most of the recent fears of the bond market are probably falling off. Like I said, one looks forward to some adjustment of the bond supply calendar. Having said that, we have made appropriate changes in our view 2 portfolios in order to accommodate this overhang of higher bonds supply, especially with respect to duration bonds. So all in all, with a reasonably large investment horizon in place, or investment horizons appropriate to risk appetite in place, we feel this is a good time to add to bond exposures across funds depending upon risk appetite. Also, from an overall asset allocation standpoint, most investors may have been somewhat underweight fixed income in favor of risk assets, and probably it's time, given attractive fixed income valuations and rising uncertainties in the world, to probably enhance fixed income within overall asset allocation as well.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.